Gas prices feel like a constant enemy. Now imagine they suddenly collapse overnight across the entire world. Fact 1. If global oil prices suddenly dropped instead of rising, American households would feel immediate relief at the pump. Gasoline prices could fall dramatically, reducing weekly expenses for millions of families who rely on cars for commuting, school runs, and daily life. Lower fuel costs would also reduce transportation expenses for goods, which could ease inflation pressure on groceries and everyday products. However, this relief would come with a hidden trade-off. Energy companies would start cutting costs quickly, leading to layoffs in oil-producing states like Texas and North Dakota. What feels like relief in one part of the country could quietly become job loss in another. Fact 2. Air travel and shipping industries would experience a major boost. Airlines, trucking companies, and logistics networks depend heavily on fuel costs, so cheaper oil would lower operating expenses and potentially reduce ticket prices and shipping fees. This could increase travel, tourism, and consumer spending across the United States. But there's a catch. When energy becomes cheaper, companies often delay investments in efficiency and innovation. Electric vehicles, renewable energy projects, and fuel-saving technologies might lose momentum because the financial urgency disappears. In the short term, Americans travel more. In the long term, the transition to cleaner energy slows down significantly. Fact 3. The US economy might initially grow faster, but global instability would increase. Countries that depend heavily on oil exports like Saudi Arabia, Russia, and others would lose massive revenue. This could lead to economic crises, political unrest, or even geopolitical conflicts. For Americans, that instability could translate into unpredictable global markets, stock volatility, and increased defense spending. So while cheaper oil feels like a domestic win, it could create international tension that eventually circles back into higher taxes, security concerns, and economic uncertainty at home. Fact 4. American oil companies would face intense financial pressure. When prices drop too low, drilling becomes unprofitable, especially for shale producers in the US. Many companies would scale back operations, cancel projects, and shut down rigs. This would hit local economies hard. Small towns built around oil production would see declining incomes, reduced tax revenue, and struggling businesses. While consumers save money at the pump, entire communities could face recession-like conditions. It's a reminder that in the energy world, lower prices don't just mean savings, they can also mean collapse for industries that millions depend on. Fact 5. If oil prices dropped globally, inflation in the United States could fall faster than expected. Energy costs are embedded in nearly everything: manufacturing, transportation, agriculture, so cheaper oil would reduce production costs across multiple industries. This could stabilize prices in grocery stores and retail, giving Americans a sense of financial breathing room. However, the Federal Reserve might face a difficult decision. Lower inflation could lead to interest rate cuts, but if the drop is too sudden, it could signal weakening global demand. What looks like relief at checkout could quietly reflect a slowing world economy underneath. Fact 6. Renewable energy investments in the US would likely slow down. Solar, wind, and electric vehicle adoption are heavily influenced by the cost of traditional energy. When oil becomes cheap, the financial incentive to switch decreases for both consumers and corporations. Large-scale clean energy projects could be delayed or cancelled, especially those relying on private investment. This would create a long-term risk. America could fall behind in the global race for energy transition. Short-term savings might feel good, but the country could become more dependent on fossil fuels again just as the rest of the world tries to move away from them. Fact 7. The US dollar could strengthen in unexpected ways. Since oil is traded globally in dollars, a major drop in oil prices often reduces demand for foreign currencies tied to oil exports. This could make the dollar stronger relative to other currencies. For Americans, that means cheaper imports, international travel becoming more affordable, and stronger purchasing power abroad. But it also makes US exports more expensive for other countries, hurting American manufacturers and farmers. What feels like financial strength for consumers could translate into lost competitiveness for key American industries. Fact 8. Energy independence in the United States could weaken. Over the past decade, the US has become one of the world's largest oil producers, reducing reliance on foreign energy. But if global prices fall too low, domestic production becomes less profitable, forcing companies to cut output. This could increase reliance on imported oil again, especially from unstable regions. For many Americans, this would raise concerns about national security and long-term stability. Lower prices today might come at the cost of strategic vulnerability tomorrow, a trade-off that could quickly become a major political and economic debate. Fact 9. Lower global oil prices would significantly impact US retirement funds and investment portfolios. Many pension funds, mutual funds, and 401k accounts are heavily invested in energy companies. When oil prices fall, energy stocks often decline sharply, reducing returns for millions of Americans planning for retirement. While people may save money on fuel in the short term, their long-term financial security could quietly weaken. This creates a difficult emotional trade-off: lower daily expenses today, but potentially smaller retirement savings tomorrow. For many Americans, that balance would become a serious concern worth debating. Fact 10. The US job market would experience uneven effects across industries. While transportation, manufacturing, and retail sectors might hire more due to lower operating costs, the oil and gas sector would likely face layoffs and hiring freezes. States heavily dependent on energy production could see rising unemployment, while urban areas might experience economic growth. This would deepen regional economic divides within the country. Some Americans would feel economic expansion, while others would experience financial hardship. The same price drop that helps one family could directly harm another, creating tension between different parts of the country. Fact 11. Lower oil prices could reduce government revenue at both state and federal levels. Taxes and royalties from oil production contribute billions of dollars, especially in states like Texas, Alaska, and New Mexico. When prices fall, those revenues shrink, forcing governments to make difficult decisions: cut spending, reduce public services, or increase taxes elsewhere. For Americans, this could mean fewer infrastructure projects, underfunded schools, or delayed public programs. The savings at the gas station might be offset by reduced government services, creating a complex trade-off that affects daily life in less visible ways. Fact 12. Consumer behavior in the United States would likely shift toward higher energy consumption. Cheaper fuel often leads to more driving, larger vehicle purchases, and less focus on fuel efficiency. Sales of SUVs and trucks could rise again, reversing years of gradual movement towards smaller, more efficient cars. While this supports industries like automotive manufacturing and boosts short-term economic activity, it also increases overall energy demand and environmental impact. Americans might enjoy cheaper mobility, but at the cost of higher emissions and long-term environmental consequences that could become harder to reverse. Fact 13. Global supply chains would become more active and competitive. Lower oil prices reduce shipping and logistics costs, making it cheaper to import goods from overseas. This could benefit American consumers through lower prices and greater product availability. However, it could also put additional pressure on domestic manufacturers who struggle to compete with cheaper imports. Over time, this might lead to further outsourcing of jobs and production. Americans would face a familiar dilemma: lower prices at stores, but fewer stable manufacturing jobs at home, reigniting debates about trade and economic priorities. Fact 14. If oil prices dropped globally, gasoline tax revenues in the United States could decline significantly. Since fuel taxes are often tied to consumption and price levels, lower prices can reduce total revenue collected for infrastructure projects like highways and bridges. While Americans might drive more due to cheaper fuel, the overall funding gap could still grow, forcing states to delay repairs or seek alternative funding sources. This could lead to deteriorating infrastructure over time. The irony would be clear: more people enjoying the roads, while the roads themselves receive less funding to stay in good condition. Fact 15. Lower oil prices could weaken the strategic importance of the United States in global energy markets. Over the past decade, America has gained influence by becoming a major energy exporter. If prices fall, that leverage decreases because exporting oil becomes less profitable. This could reduce the country's influence in international negotiations related to energy and trade. At the same time, lower global energy costs could reduce tensions between energy importing nations. Americans might see fewer global conflicts tied to energy, but also a quieter, less dominant role for the US on the world stage. Fact 16. The housing market in certain US regions would feel unexpected pressure. Areas that rely heavily on oil industry jobs, such as parts of Texas, Oklahoma, and North Dakota, could experience falling home prices as workers lose jobs or relocate. At the same time, regions that benefit from lower energy costs might see increased demand and rising prices. This would create a fragmented housing market where some communities face decline while others grow rapidly. For many Americans, this would raise difficult questions about where to live, invest, and build long-term financial stability. Fact 17. Lower oil prices could reduce military operational costs for the United States. The US military is one of the largest consumers of fuel in the world, so cheaper oil would lower expenses for training, transportation, and global operations. This could free up billions of dollars in the defense budget for other priorities, or reduce overall government spending. However, if global instability increases due to economic pressure on oil-dependent countries, military involvement abroad could rise. The savings from cheaper fuel might be offset by the cost of managing new conflicts or geopolitical tensions. Fact 18. Public transportation systems in the United States could lose momentum. When fuel prices are low, fewer people feel the need to use buses, trains, or subways, especially in suburban and rural areas. This can reduce ridership and revenue for public transit systems, making them harder to maintain and expand. Over time, cities might delay or cancel transit projects due to lower demand. While individuals benefit from cheaper driving, the long-term development of efficient, large-scale transportation networks could slow down, reinforcing car dependency and limiting mobility options for future generations. Fact 19. Lower global oil prices could reshape the American auto industry in a lasting way. When fuel is cheap, consumers tend to favor larger vehicles like SUVs and pickup trucks, which are already dominant in the US market. Automakers would likely shift production further in that direction, reducing investment in smaller, fuel-efficient models. While this supports profits and aligns with consumer demand, it also increases long-term fuel consumption and dependence on oil. If prices rise again in the future, Americans could find themselves locked into less efficient vehicles, facing higher costs with fewer alternatives. Fact 20. Agriculture in the United States would experience both relief and risk. Farmers rely heavily on fuel for machinery, transportation, and fertilizer production, so lower oil prices would reduce operating costs. This could improve profit margins and stabilize food prices in the short term. However, global agricultural markets would also become more competitive as transportation costs drop worldwide. American farmers could face increased competition from cheaper imports, putting pressure on domestic prices. What begins as financial relief could turn into a struggle to stay competitive in a more aggressive global market. Fact 21. The financial markets in the United States would likely react with increased volatility. Energy companies make up a significant portion of major stock indexes, and a sharp drop in oil prices would lead to declining valuations in that sector. This could drag down overall market performance, affecting investors far beyond the energy industry. At the same time, sectors like transportation and retail might rise due to lower costs. The result would be a divided market, where gains in some industries are offset by losses in others, creating uncertainty for investors and everyday Americans alike. Fact 22. Lower oil prices could reduce the urgency of climate policy in the United States. When energy costs are high, there is stronger political and public pressure to invest in alternatives and reduce dependence on fossil fuels. But when prices fall, that urgency often fades. Policymakers may delay or scale back climate initiatives, and public support for environmental measures could weaken. While Americans benefit financially in the short term, the long-term consequences could include slower progress on emissions reduction and increased vulnerability to future environmental challenges. Fact 23. Rural communities in the United States could face deeper economic challenges. Many rural areas depend on energy production jobs or related industries. When oil prices fall, these jobs are often among the first to disappear. Local businesses, from restaurants to equipment suppliers, would feel the impact as spending declines. This could accelerate population decline in already struggling areas as workers move elsewhere for opportunities. While urban consumers enjoy lower costs, rural America could experience another wave of economic contraction, widening the divide between different parts of the country. Fact 24. Lower oil prices could influence how Americans perceive economic leadership and policy decisions. Even if the price drop is driven by global factors, Many people associate fuel prices with government performance. A sudden decrease could boost public confidence and create a sense of economic improvement. However, if the negative effects, job losses, reduced investment, global instability, become visible later, that perception could quickly reverse. This creates a powerful emotional cycle where short-term optimism gives way to longer-term concern, shaping political debates and public opinion across the country. Fact 25. Lower global oil prices could reduce the cost of heating and electricity for millions of American households. In colder states, where energy bills can become a major financial burden during winter, this would provide meaningful relief. Families might have more disposable income, improving overall quality of life. However, utility companies could see reduced revenues, potentially delaying infrastructure upgrades or maintenance. Over time, this could impact energy reliability. What feels like immediate comfort, lower monthly bills, could slowly translate into underinvestment in the systems Americans depend on during extreme weather. Fact 26. The US trade balance could improve in the short term, but worsen in the long term. Lower oil prices reduce the cost of imports, which can narrow trade deficits temporarily. However, as domestic production declines due to lower profitability, the United States may begin importing more oil again. This reverses years of progress toward energy independence. Americans could benefit from cheaper goods initially, but the long-term effect might include greater reliance on foreign suppliers, exposing the economy to global disruptions and price shocks in the future. Fact 27. Lower oil prices could slow innovation in energy technology across the United States. When oil is expensive, companies invest heavily in alternatives, battery storage, electric vehicles, and efficiency improvements. When it becomes cheap, those investments often lose urgency. Startups may struggle to attract funding, and large corporations may shift focus back to traditional energy. This creates a long-term risk where the US falls behind in emerging technologies that could define the future global economy. Short-term savings could come at the cost of reduced leadership in one of the most important industries of the future. Fact 28. The airline and tourism industries in the United States could expand significantly. Lower fuel costs would allow airlines to increase routes, reduce ticket prices, and improve profitability. This could make travel more accessible to middle-class Americans, boosting tourism, hospitality, and local economies. However, increased travel also means higher overall emissions and environmental impact. Additionally, tourism-heavy regions could face overcrowding and strain on infrastructure. What begins as economic opportunity could evolve into challenges around sustainability and long-term planning for growing demand. Fact 29. Lower oil prices could affect how Americans view electric vehicles. When gasoline is cheap, the financial argument for switching to electric cars becomes weaker. Consumers may delay purchasing EVs, slowing adoption rates across the country. This impacts not only automakers but also the development of charging infrastructure and related industries. While some buyers will still prioritize environmental concerns, many will focus on immediate cost savings. The result could be a pause in momentum just as the transition to cleaner transportation was gaining speed, creating long-term consequences for energy policy and industry direction. Fact 30. Lower global oil prices could change the long-term financial strategies of American businesses. Companies across multiple industries might prioritize short-term cost savings over long-term resilience, delaying investments in efficiency, diversification, and sustainability. This could make businesses more vulnerable to future price shocks if oil markets become unstable again. While profits may rise temporarily, the lack of preparation could lead to sharper disruptions later. For Americans, this creates a cycle of economic highs followed by sudden downturns, raising an important question: is short-term relief worth long-term vulnerability? Fact 31. Lower global oil prices could reduce inflation expectations in the United States, influencing wage growth. When inflation slows, employers often feel less pressure to raise wages, especially in industries sensitive to cost increases. While Americans may benefit from lower prices on fuel and goods, their income growth could stagnate. Over time, this creates a subtle but powerful effect. Expenses stabilize, but earning power does not improve at the same pace. For many workers, this could feel like running in place financially, even as the broader economy appears more stable on the surface. Fact 32. Lower oil prices could shift global manufacturing patterns in ways that impact American jobs. Cheap transportation reduces the cost advantage of producing goods closer to consumers. Companies may once again prioritize overseas manufacturing where labor is cheaper, knowing shipping costs are no longer a major barrier. This could reverse some reshoring trends seen in recent years. While consumers benefit from lower prices, American workers in manufacturing sectors may face renewed competition and job insecurity. This tension between affordability and job stability could become a central issue in economic discussions. Fact 33. State budgets tied to energy revenue would face difficult trade-offs that directly affect everyday Americans. In states like Alaska, oil revenues fund public services, including annual payments to residents. A sustained drop in oil prices could force cuts to these programs or reduce direct payments to citizens. Schools, infrastructure, and public services could also face budget constraints. While lower energy prices benefit consumers nationwide, residents in these states would feel a more immediate and personal impact, turning a global economic shift into a local financial reality. Fact 34. Lower oil prices could reduce the urgency for energy efficiency across American households and businesses. When energy is cheap, people are less likely to invest in insulation, efficient appliances, or energy-saving upgrades. Businesses may also delay improving operational efficiency. This leads to higher overall energy consumption over time, even if costs remain low. The long-term effect is a less efficient economy that becomes more vulnerable when prices eventually rise again. Americans may save money now, but they could face higher costs later due to missed opportunities for efficiency improvements. Fact 35. Lower global oil prices could reshape how Americans think about long-term economic security. On the surface, cheaper fuel feels like a clear benefit: lower costs, easier living, more financial flexibility. But underneath, it exposes a fragile balance between consumer relief and structural risk. Job losses in key industries, reduced innovation, global instability, and long-term dependence on fossil fuels all become part of the equation. This is not just about prices, it is about trade-offs. Americans would be forced to confront a deeper question. Does short-term comfort outweigh long-term resilience? Lower prices feel like relief until the hidden costs arrive. Which side matters more?